Good afternoon. My name is Faisal Bagwala and my subject is Accounting for Manager. Today I have discussed a wonderful topic is ratio analysis. What is ratio? First of all, I have discussed about of ratio. Ratio is an expression of an quantitative terms between two numbers. Means ratio is a comparisons of a two levels. So it is a comparison between two numbers. So it is helpful in ratio. Ratio in three terms. First is in percentage, ratio in times, and ratio in rupees. Now we are discuss about of ratios meaning. First is meanings. What is ratio? Mathematical relationship between two items. It is a relationship between two items. It is a before this slides I discuss about of this is a ratio. It is a quantitative terms. So it is a comparisons between two items expressed in quantitative forms. Like now before these slides I have discussed ratio in three forms: percentage, rupees, and times or numbers. So it is in all these three way it is expressed in quantitative form. Now this is the definitions given here. What is ratio? Relationships expressed in quantitative terms between figures which have cause and effects, relationships or which are connected with each other in some manner or the other. Means the definition is just so that this is the figure which show that these are two items, comparison between two items. Suppose for the figure is taken from like in percentage ratio in terms in percentage like 10% company A, and now the next company B is the ratio in percentage is 12%. So there is a difference, there is a figures 10% or 12%. So it is a comparison between two figures like that. Between figures have cause and effects, and between and these figures they are the effects. Like cause means like they have any cause or effect, which effect they are putting in this business. So it is a just a relationship between two figures and cause and effects of the business. Now next, what is the advantages of ratio? First advantage is forecasting. Forecasting in simple we call in Hindi like that, it is a purvanuman. Like in forecasting they are the forecasting what their ratio is given to them. So it is now first advantage is forecasting. Next is managerial control. Each and every company or in each and every firm they have a manager, and then manager have a skill ability to control the business firms or business or whatever the company situation is, to control that. So in that situations managerial, what manager do? Manager is comparisons this ratio to before year or this year. So it is the comparisons, how they profit they earn, how they are earning, the situations of their profit or is goods or not. So it is all that they related to managerial control. Number 3, facilitate communications. Means there is a communications means we are given a any message to anyone. So in that situations forecasting facilitate communications. Ratio is a given a best or a desirable relationships or communications to other. Number 4 is measuring efficiency. The main parts is 4 is measuring efficiency. Each and every firm or company they have their efficiency or not, means the efficiency is good or not. So they are checking that the ratio is given the informations about of measuring efficiencies also. The business performance is going as well or not, or the business position is going in bad situations or loss situations. So measuring efficiency. Inter-firm comparisons means suppose they have one person's proprietor, they have 2 or 3 firms. So one firms have a good profit is good, like 50% they are earning more than other firms. Like in other firms they have a 10% 40% profit. So there is a comparison between inter-firm comparisons like that. They are given 50%, they are given 14%. So in that situations they are comparisons, inter-firm comparisons. Next, limitations. What are the types of limitations? Practical knowledge. In ratio, without practical knowledge you cannot calculate any ratio in accounting. So the practical knowledge as well as calculations knowledge they have required to calculate this ratio. So the main thing is practical knowledge. These types of ratio is calculated by means manager or CA, like chartered accountant. They are the comparisons. They have the knowledge about of these things. So this is the main thing, is practical knowledge. Suppose they are not doing any CA, like they are not having any manager or that, they are only clerk. So in that clerk situations, there is a practical knowledge is less. So it is main difference, main limitations is practical knowledge. Interrelationships. Now interrelationship means that they have the two or more firms, so they are comparisons. So that in that situations there is a lack of interrelationships. So it is interrelation. Accuracy of financial information. Ratio is calculated on the balance sheets, profit and loss accounts, budgetary control systems. So in that information is taken from them and they are calculated. So in that situations, if financial information is not accuracy, so in that situations the limitations is there. Consistency of preparations of financial statements. Consistency means like in Hindi we call as sangitta, like sangatta. So in that situations, if financial statement is not means compare in that consistency, so the main limitations is also there. Time log. Ratio is a calculations about of time log. In business, each and every transactions are recorded day to day. So in that situations, time log is means time means there is a one particular day diary, we call a day diary. What about the day in the situations of day, in particular one day, how many transactions are business are there. So in that situations, day diary or time log, they are noted each and every transactions of business. So if we are not maintain our day diary or we are not maintain our time log, so in that situations limitations are there. Now next, there is a classifications of ratio. In classifications, first we are discuss about of solvency or financial ratio. Solvency means short term solvency ratio, means first is current ratio. Current ratio is calculated in this formula: current assets divided by current liability. Next, liquidity ratio, liquid or quick asset divided by current liabilities. Now I discuss about current assets. Current assets are there: bank, debtors, market security, and bills receivable. This is all known as the current assets. Current liabilities. Current liabilities are there: provisions of tax, short term creditors, bills payable. It is all are there. Bank overdraft is also there. Current liability. Now quick assets. What is quick assets? In quick assets, there is a 1 year. There is a each and every assets are converted into cash within 1 year. So it is known as a quick assets. Current liabilities divided by current liabilities. Now next, third is cash position ratio or absolute quick ratio. Cash and bank balance. There is only cash and bank. In absolute ratio, whatever cash we have right now, so in this formula only cash and marketable securities are there, divided by current liability and minus bank overdraft. Why bank overdraft is minus? Because it is a liability, we are not paid right now. So in that situation, bank overdraft is minus. So this is a solvency ratio. Now we are calculate this ratio in numerical terms. Now these are the examples we are taken. From the following information regarding current assets and current liability of the firm, calculate the solvency or financial ratio. Now we are calculating this ratio. There is the informations are given. First is current assets, rupees; current liability, rupees. In current assets, cash, debtor, marketable security, stock, prepaid expenses, cash at bank. Prepaid expenses means which types of expenses which are given, which are not given, right, which are given more than from is liability. So it is prepaid expenses. Current liabilities, creditors, bills payable, outstanding expenses. Outstanding means what which we are not given yet. So it is outstanding expenses, bank overdraft, provisional taxes. Now there is a calculations of solvency. First is current ratio. There is a first number is current ratio. Current assets is divided by current liabilities. In current assets, which types of current assets we are taken from? Neither cash, debtor, marketable security, stock, prepaid expenses, cash at bank. All are current assets. Now the total of these assets are 3,50,000 rupees. Now current liability. What types of current liabilities are there in creditors? Is also bills payable, outstanding expenses, bank overdraft, provisions for tax, 75, 25,000, 15,000, 15, 20,000. Now all total are in current liabilities. What is the total? 1,50,000. Now 3,50,000 divided by 1,50,000. So the ratio is so that in proportions form 2.33 ZAM 1. Now there is a reasons behind this. It means that it is a desirable to have rupees 2.3 worth rupees of current assets for every rupees 1 of current liabilities. The ratio is so that the financial positions or the firm's position is very good. Because why? There is a more current assets than current liabilities. Current liabilities have a in current liabilities there is a 2.33 rupees of each and every current liability of rupees 1. So the ratio so that the position is good of this business. Now next ratio we are calculating this quick ratio, quick or liquid ratio. We both speak same name. Now only quick assets divided by current liabilities. Now quick assets, I already told that what is quick asset is there. It is converted within 1 year. It is converted into in cash. So in this it is known as a quick assets. Now quick assets is current asset minus stock. Why stock is not there or prepaid expenses are not there in quick assets? Because stock is a goods. So in that situations goods are transfer in next month, next year is also. It is not converted into cash. So it is stocks is minus and prepaid expenses is also minus because we are given more to our debtor or creditors. So it in that situation prepaid expenses is also minus. So quick assets are only we are taken from them like digits: cash, debtor, marketable security, stock we are not taken, prepaid expenses we are also not taken, and cash at bank. So 75,000 we are not taken. So the total is 2,75,000. 2,75,000 divided by current liability, because it is we are finding of a quick assets or liquid ratio 1,50,000. All current liabilities are there. The situation is that 1.83 ZAM 1 proportions base. Now there is a each and every reasons of this. It means that quick assets rupees 1.83 is good positions of the business, because quick assets is more than current liabilities. So it is a good position of the business. Now next ratio we are calculating absolute quick ratio. Absolute quick ratio means only the cash or bank we are taken, which we have right now in cash, or we have money related transactions also, only cash and bank plus marketable securities. Now we are taken cash, bank plus marketable security, and in current liabilities divided by current liabilities minus bank overdraft, because this is our bank overdraft is not our quick assets, so quick liabilities. So we are calculate our cash, bank and marketable security. Now cash is 1 lakh, cash at bank 75,000 and marketable security is 50,000 rupees. 1 lakh, 1,50,000 and 2,25,000. It is our current or quick absolute quick assets. Now in that situations all are current liabilities, only minus bank overdraft 15,000 we are deducted from them current liabilities. So in that situation 1,50,000 minus 15,000 we saw that. Now that 1,35,000, only 15,000 is we are deducted from current liability. So 2,50,000 divided by 1,35,000. So the situation is that 1.67 proportion ZAM 1. So in that situations the quick cash or bank positions is also good from financial position. So this is the absolute quick ratio. Now next, profitability ratio. What types of profitability ratio are there in ratio? First is gross profit. Gross profit is equal to gross profit divided by net sales multiplication by 100. In gross profits you are taken this profit from trading account. In trading account there is a debit or credit sides. Debit sides opening stock, purchase return minus purchase returns, all wages and freights. Now in debit credit sides you are taken closing stock, sales minus sales returns. So in that credit sides is more then debit side. So the gross profit is earning. So gross profit, net sales means what? Sales minus sales return. So it is what types of return is deducted from sales. So we get it the net sales. Net operating ratio, operating profit, net profit after tax divided by sales, multiplication by 100. So it is a operating profit. Operating profit we are taken from the profit and loss accounts only. For profit and loss accounts, all expenses are deducted from all income sides, from credit sides. Credit side is more than debit sides. And now operating ratio. Cost of sales plus operating expenses divided by net sales, multiplication by 100. Now cost of sales means what? There is a cost of sales like we are taken from opening stock plus purchases minus closing stocks. So we get the cost of sales. Operating expenses there are given in the profit and loss accounts. Net sales we are already discussed about, so net sales multiplication by 100. Now this is the examples, we are calculate these examples also. Sales 15 lakh, less cost of goods sales 30 lakhs, less interest 1,50,000. So net profit is 18,50,000. Now less taxes, 50% are there taxes. So 18,50,000 we are deducted from 50% tax. So there is a divided by 2 also, or we can calculate like 9,25,000. So profit after tax is 9,25,000. Now we are calculating profit ratio. First is gross profit. First of all, gross profit divided by net sales, multiplication by 100. Now gross profit, how we can calculate? First we are going from the digit. Now sales 15 lakh. So net sales is 15 lakh. Now how to calculate gross profit? Gross profit is calculated sales minus cost of goods sales. In cost of goods sales I discuss first is opening stock plus purchases minus closing stock. So in that situations, cost of goods sales minus cost of goods sales. So we can get the gross profit 15 lakh minus 13 lakh. So we can get the gross profit is 20 lakh. Now gross profit 20 lakh, net sales there is no sales return. So 20 lakh divided by 15 lakh, multiplication by 100. So in that situations the ratio is come in the proportions of 40%. Now next we are calculate the net operating profit. How net operating profit is are calculated? Net profit after tax divided by sales, multiplication by 100. First of all we are discuss about of net sales. We are going from the digits. Now there is a net profit 18,50,000 rupees, but in net profit there is a profit after tax. So in net profit after tax is 9,25,000. 9,25,000 divided by sales, it is 15 lakh, multiplication by 100. So in that situations we are showing that net profit after tax 9,25,000 divided by 15 lakh, multiplication by 100. So the profit is 18.5%. It is ratio is calculated in percentage. Now next, what? Operating ratio. What is the operating ratio? Cost of sales plus operating expenses divided by net sales. Now in the we are move on to the digits. Okay, now there is a sales given 15 lakh rupees, but there is no any operating expenses are given in the digit. So what we take on only cost of goods sold 30 lakh plus operating expenses are 0, net sales is 15 lakh, multiplication by 100. So the operating ratio is 16%. Now next is long term solvency ratio. There is a classification of ratio. First is we are calculating solvency. Now next is profitable, and third one is long term solvency ratio. Long term solvency ratio are that fixed asset ratio, all fixed asset divided by long term funds. Fixed asset, what is the fixed assets are there? There is a machinery, it is a fixed asset. Vehicle, it is a fixed asset. Buildings, lands, it is a fixed asset. Now long term funds, in long term funds there is a equity and preferences, debt, debentures, all are long term funds. Now next is debt equity ratio. What is debt equity? Long term, total long term debt divided by shareholder funds, or external liquidity minus internal liquidity. Total long term funds means all funds like equity, preferences, term loan, debenture, all are there in the long term. Shareholder funds, only equities are there in the shareholders funds. So it is a debt equity ratio. Now proprietary ratio, proprietary. Now shareholders fund, we already discussed, only the equities are there in the shareholder. All total tangible assets. Now there is assets are between two types, tangible and non-tangible. In tangible, we are touch the assets and we see these types of assets. Now intangible, there is a goodwill which we cannot touch, which we can only we cannot see that. So it is intangible. Now tangible assets are only machinery, buildings, land, vehicle, all are tangible assets. Now this is the ratios are only there. So this is the basic abouts of ratio, and we are just given the about of ratio. So thank you so much and have a nice day.